And with that, I'd like to hand it over to the duo for providing us with the market forecast.
Great. Thank you very much, Steve, for that incredibly warm introduction. We are honored to be here today and to talk to you once again about what we're seeing in today's economy and in the marketplace. Before we start, I do want to acknowledge a lot of the information we give tends to be a little bit dry, a little bit numbers oriented, and we would be remiss if we didn't really talk about the human dimension and emotional and economic impact that it has had to people's lives over the last year. And certainly I'm sure that a number of people that are on this call have been personally affected or know someone that has been affected by COVID. I'm certainly fall into that group of having a family member who unfortunately passed away due to COVID. And so our thoughts, our hearts, our prayers really go out to all those families who have been impacted. With that, here's what we're going to talk about today. So our focus is really going to be, how did we get here? What happened in 2020? Where are we now in 2021? And what are we expecting in 2021 and beyond? Before I start, we do have some required disclosures that I do need to go read. And that is, please remember that there can be no assurance that the content made reference to directly or indirectly in this 2021 market forecast will be profitable or suitable for your individual situation or prove successful. Due to various factors, including changing conditions and or applicable laws, the content is only reflective of current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that any discussion or information contained in the 2021 market forecast serves as a receipt of or as a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. A copy of Affiance Financial's current written disclosure brochure discussing our services and fees continues to remain available upon request. It's like a radio commercial.
Thanks, Seth. I think we love Zoom, but like Steve said, we hate not being with everybody. It's something we definitely miss, and hopefully we can be together next year. We like to start off with a quote. This is one from Albert Einstein that we've modified slightly to apply to our situation, but he said, as far as the rules of investing refer to reality, they are not certain. And as far as they are not certain, they do not refer to reality. We take a lot of humility. We approach this process with great trepidation. Forecasting is fraught with many problems, and we know that our ability to forecast what's going to happen tomorrow is modest at best, but we do give it our best shot. Like Yogi Berra said, the future ain't what it used to be. We definitely do our best.
So, Marc, I seem to recall last year when we did this in person that you had predicted that there was going to be the emergence of this virus leading to a global pandemic, an economic shutdown, and where everyone was going to end up working from home, and that the market then was also going to collapse and very quickly recover and actually end up ahead for the year. Was that right?
Well, Seth, I remember thinking about none of those things. We didn't have any of those on our radar screen at the time. Clearly, we didn't know what was coming in January of last year.
Yeah, so I think that's something that no one had really predicted in terms of how that year played out. In fact, here's what we talked about back in January 2020. We did talk about the Fed starting to ease their policies because of seeing slower global GDP growth and how that was playing out. We also talked about the Treasury yields were rising, which will seem kind of funny as we go through this presentation. Trade with China, that was the big conversation we had as we were starting the trade wars at that point in time. And then I think one of the few things that we got right was that there was going to be an election in 2020. So feel pretty good about getting that one right.
That was on the calendar, actually.
And the other thing we talked about, we spent a lot of time, was with regards to valuations. In January 2020, we were concerned about valuations, stock valuations, and the big question was, would corporate earnings keep up with the rise in valuations?
So we know what the problem was last year. The problem was COVID-19. And this is a description or graph, if you will, of what happened last year. We saw coronavirus cases start to move higher in the early part of the year, and then sort of level out, go higher in the summer, and then really increase in the late part of last year, running 150 to 200,000 cases a day. With total cases, we know this slide was prepared a few weeks ago, 22 million. We know it's over 25 million. So clearly, COVID-19 is the headline of 2020. We expect it will continue to be the headline of 2021.
You know, Mark, in retrospect, when you look at those numbers, it's like, it's so much worse now than it was in March and April. It's like, what were we worrying about then compared to today?
Little did we know, right? The lockdowns, those were good times compared to where we are today.
So as a result of COVID, really what happened is economy went almost to a standstill in many respects. And you can see this graph. This is GDP growth rate, and it drops by a third, literally just falls off the cliff. But there's another part of the story too, which you can see, and that is the rise in GDP as well. So let's take another look at that in terms of by quarter. And what you can see again is we had about a 1/3 drop in the market, a little bit more than that, or in GDP growth, and then followed by a 1/3 increase in GDP. But the two don't net each other out because it's really point to point. So my example is you take a glass, pour out a third, you're left with 2/3. Now you're adding a third of the 2/3. So we're back to about 85% of where we were in terms of the GDP, which again is not great, but not horrible compared to what things were looking like back in March, April.
You know, so we just got the number for the last quarter. The first estimate is about 4%. So still positive, but not as high as the huge snapback we saw earlier this year, but on the right side at least.
For sure.
We know the unemployment rate spiked as a result of the government shutdowns, and the 14.8% high, something we haven't seen really in modern history. As the government shut down, it was really a self-imposed shutdown and recession, unlike others we've ever seen. People didn't have work to go to, and so this huge spike happened, and then huge recovery, really. I mean, quite dramatic, back to about 6.8%. Still nowhere near the 4% rate we had at the beginning of 2020 going into this period, but an improvement nonetheless.
And that we're going to refer to that 6.8% later in the presentation, so keep this slide a little bit in mind. In terms of the stock market really followed GDP in terms of the shutdown. Very quickly, the market fell apart, dropped close to 34% drop in literally weeks. But the other part of the story, which was amazing, and certainly no one could predict it, is the recovery. So a 70% increase in the market from bottom to top. And ending the year with the S&P 500 up 18.4%, really just a dramatic change from down to up in the marketplace.
This was the fastest stock market recovery in history. This slide sort of helps to illustrate how fast it really was, from almost this 34% drawdown back to where it was in 128 days. I mean, just really 4 months or so. And we compare that to past downturns, 1,426 days in the 2007 to 2009 recession, Great Recession, if you will. 2000 to 2002 took 1,800 days. So 4 to 5 years compared to 4 months. It's really a dramatic difference. Now, different situation nonetheless, but clearly a really dramatic recovery.
Right. This is very unusual. The bond market was affected too, but certainly much more stable than the stock market. You can see that back in March, the bond market did drop, but clearly not nearly as much as the stock market did, and that the bond market did end up positive for the year, a positive 7.5%. Now, that isn't based upon the interest rate or the yield that bonds generate, but that's really based upon the drop in interest rates leading to an increase in bond prices. So the rise in bond prices created the return, or a large part of the return. The other part of the story is to notice how smooth the bond line is compared to the stock line. And certainly that's an important point about being diversified because of economic shocks or stock market shocks. And it's a good reminder.
If we take the same information and expand it out globally, so the blue line on top is the S&P 500, the orange line in the middle, bonds again, and we put on top of that the global AQI index up 16.3. That's the gray line. So really followed pretty closely US markets, and that's US, international, and emerging markets combined. We also look at the emerging markets, which is the darker blue line, which lagged in the initial part of the recovery back in March, April, and May, but then really caught up the latter part of the year to end almost even with the United States. Now, the emerging markets index is comprised mostly of China, which is about 40% of the index. So not a surprise knowing that. International developed markets, though, did lag. Now, clearly, we're participating in the downturn, came back up with the markets, and then kind of trailed off. Still had a good year, up 8%, but not close to the other US and emerging markets. There are some structural reasons for that. The indexes aren't all the same in terms of what they contain. And we know that the developed international markets contain less of the high-tech, higher growth companies that China and the US have. And that's one of the reasons, because those companies really led the stock markets out of this downturn, and we know the international developed markets have less exposure to those markets. So that's one of the reasons it's lagged.
So what is the reason for the sudden rise in the economy and the market? In our opinion, it's due to our two uncles, Uncle Sam and who we call the Fed, Uncle Jay Powell to the rescue, throwing money around. So let's go into a little bit of detail about what they did.
Let's first start with Uncle Jay, the Fed response. So the Fed responded in a fast and dramatic fashion, adding almost 3.6 trillion to their balance sheet. What did they do? Right away, they cut interest rates to almost zero, back to the lows of 2008, 25 basis points or 0.25%. They then cut reserve requirements for banks to zero, hoping to make sure that banks continue to lend even in this environment. They cut the discount window rate by 1.5%, and that's the rate banks can borrow from the Fed, so making sure money is easy for other banks to get. They started quantitative easing, or QE, we call it. They were buying commercial paper, buying treasury bonds, buying corporate bonds and ETFs, and for the first time actually bought in the public markets. Generally, they're buying bonds in private markets, but actually in the listed securities market. They haven't done that before. And they actually did buy some of the bonds to make sure that the liquidity in the sort of retail corporate bond market was still really good, because things had slowed down, especially in the early part of March. The Fed stepped in to backstop money markets, and I call banks and all things financial. They stood up and said, look, we are going to do whatever it takes to make sure markets function properly, liquidity is there, and people are not worried that their money market funds are going to break the dollar. We are standing behind this economy 100%. So huge response by the Fed, and of course, huge response by the government.
Yeah, so Congress really stepped up as well in terms of coming to the rescue with the CARES Act that provided a stimulus check for a lot of people, as well as adding $600 in weekly unemployment. They also added the PPP loans for businesses. They've recently passed $900 billion of additional COVID relief, and there is talk of another request for another 1.9 trillion from Congress.
It was just backed today by 120 economists. We'll see what that means.
Yeah.
So what did they do? Really, the Fed and Congress stepped in to fill what we call the COVID hole in the economy. So about 7.2 trillion went in to fill this hole. Our annual GDP, gross domestic product, for the United States is about 21.5 trillion. So filling in about a third of our total GDP with stimulus so far. Now, we can argue whether the stimulus has been enough or too much. Is it overflowing? Is it not enough? I think the consensus is there's still more that needs to be done as we roll into the second year.
It is pretty interesting, Marc, that we showed earlier that GDP fell by about a third, and the stimulus is roughly about a third of today's GDP.
Yeah, it kind of seems to match, right?
Yeah. To illustrate what the Fed's doing, we thought that this would be helpful. So here's the Fed funds rate. And this is important because it does affect you in terms of borrowing, refinancing mortgages, etc. And what you can see here is going back to really 2009, but interest rates were really low. Back in January 2016, it was still at less than 0.5%. And basically coming into 2017 is when the Federal Reserve finally said, okay, we think the coast is clear, and started slowly ratcheting up interest rates, getting up to above 2%, not quite 2.5%. And that's when GDP, when it hit that 2% mark, that's when GDP started slowing down back in kind of 2018-19 time. And the Fed started easing off the gas, and they were slowly ratcheting back down interest rates. And that's what we talked about in January 2020. And then look what happens. COVID comes, interest rates literally just fall off a cliff. And here we are today at 0.25%. So the change in interest rates has been dramatic, to say the least. The other thing the Fed we talked about was quantitative easing, or increasing their balance sheet. And again, we want to illustrate what does this mean. And so you can see back in 2009, we were talking about what they were doing when they were increasing their balance sheet, and we felt it was dramatic. And that really pales in comparison to what they did in 2020. I mean, just such a significant increase in the balance sheet. And what's also interesting was what Jay Powell said, the Federal Reserve Chairman, a couple of weeks ago, where he said, now's not the time to be talking about exit. The economy is far from our goals, and we are strongly committed to using our monetary policy tools until the job is well and truly done. So I think that gives you a pretty good indication of where the Federal Reserve is at in terms of COVID, basically that they are not done yet.
So we saw central banks act not just in the United States, but around the world. It's not a United States issue. This is a global pandemic. And in the chart at the left, we can see the Federal Reserve balance sheet layered on top of the Bank of Japan, the European Central Bank, and the Bank of England, all increasing their balance sheets to try to help their economies stay afloat during this pandemic. Even more dramatic, I think, is showing the change on the right side. The same banks, you can see, put almost $8 trillion into global economies last year to help stem the impact of COVID-19. So really massive stimulus and fast action by most of the banks around the world to try to help economies stay afloat during this time.
So what does this mean in terms of what the Federal Reserve and Congress have done? The analogy that has been used is basically like dropping money from a helicopter. And so this is an example of money supply. And what you can see is that the money supply grows, but it grows at a pretty smooth rate. And then you have money supply in 2020, and you can see how much it skyrockets. And again, this money supply, this is cash in checking accounts, deposit accounts, money markets, etc. And this is real cash. And the money has increased dramatically. So what does that mean? What that means is that it seems to be working. This is the weekly economic index. And you can see that we have this big drop in 2020, literally it just falls straight down. And then a very sharp recovery week in, week out. And a lot of this, we believe, is because of the actions by Congress and by the Federal Reserve. It's also interesting, compare that to where we were in 2009, where it was much more of a kind of a U-shaped, a longer term recovery, not nearly as deep, by the way, as what we experienced in 2020, which is kind of hard to imagine. But it does appear that the activities by the Federal Reserve and by Congress have made a dramatic difference in the economy this is one of the measures.
You know, Seth, it really looks different. I mean, it looks in this case like we sort of hit a brick wall. I think your analogy from before, you said, hey, this is more like a natural disaster than a normal recession.
Yeah, I definitely think that way, where it's something that is here and then it disappears relatively quickly, and certainly that's what we're hoping for with COVID, that it will be a return to normalcy in 2021.
So we do see the stimulus working across much of the economy. This is the Manufacturing Purchasing Managers Index, or PMI, and you can see the rapid fall off last year when things were shut down, the rapid recovery, and not just the recovery. I think the interesting thing here is the 50 line across the middle is where above that manufacturing is expanding, below that contracting. So not only did we go above 50, we actually went above 55. We went above where we were at the early part of 2019, at late 19 and 2020. So manufacturing has really come back strongly. And I think in part because they've learned how to work with COVID, with social distancing, with masking and things like that. And they've brought people back to work so that manufacturers can stay in business. At the same time, we've actually seen a similar rebound in services. Again, the same data series, but for services instead of manufacturing, a similar dramatic bounce back above the 50% line again, now tailing off a bit. We'll see how that goes forward, but nonetheless, it really bodes well that, again, the services industry, and to some extent, that could be some of the professions that work better with Zoom, that may not have to go back to offices and things like that and have more ability to work remotely. So there are some things that influence these indexes, but nonetheless shows the economic rebound and that the stimulus is working. And we know that the situation isn't the same for everybody. The COVID impact has been unequal and unfair, but that's how it is. And we know the travel, entertainment, and food service industries in particular have been hurt very hard and hit very hard. And we know, for example, travel, we've tracked some of the data there closely, and airlines fell off to almost zero last spring and are still only back to about 50% of where they were before the pandemic. We know technology and healthcare in particular have done well. Technology stocks in particular have led the return through most of 2020. Healthcare has done well as well, being able to take care of people both in hospitals, which they've had to do, and then the remote or telehealth has exploded. So certain technology and healthcare areas have done well. Retail and energy haven't done well, both hurt by the recession and the downturn. Now, certain pockets of retail have done well, but in general, bricks and mortar have really suffered. And the home improvement and staples areas have done well. People stayed home, they worked on their homes while they were home, and they went out and bought food. So different areas were impacted very differently during this downturn and subsequent recovery. I think one of the things that's kind of interesting that we did some little more research on was e-commerce. Over the past 9 years, e-commerce has grown at about a 10% rate. And that may seem, I don't know, pretty good, not good, depends on how you look at it. But if you look at it from the percentage of what that means for numbers, this is a $5 trillion market in the United States alone, 26 trillion globally. And this shows the penetration of e-commerce in the retail market. And so every percentage increase is about $50 billion. 2020, we saw this jump 26%, or from about 12 to 16% of the retail market, a dramatic increase. And I know I think we have to use the analogy again, but Seth, what did you say about Amazon?
Yeah, I had this joke at a previous presentation that I did where Amazon came and knocked on our door to make sure we were okay. They had made a delivery in a couple days. And really just trying to say just how frequent it seems with UPS and FedEx and Amazon, it's really incredible.
But it does show that certain industries benefited, in this case, e-commerce, and the increase in e-commerce as the pandemic forced it to some extent, but pulled some of what may have been future penetration rates forward in time and really accelerated some of the technological innovations and increases in 2020 that we may have not seen until later.
So how did this affect consumers? How did this affect you in terms of what happened to COVID? And I think it's pretty interesting. Overall, a lot of people are better off, and we're going to break this down. So wages in aggregate dropped about 43 billion, and that's through November of 2020. On the positive side, though, we had unemployment insurance benefits, we had the stimulus checks, we also had PPP loans. So net personal income increased by about $1 trillion. Taking a look on the spending side, spending decreased dramatically. Why? Because people weren't traveling, people weren't going out to eat, people stopped paying student loans. Some spending did increase specifically for home improvements, but net, we know that spending dramatically decreased. The net result is that a lot of people are better off today than they were prior to COVID because of increased personal income, some of it from government spending, and decreased spending. This is also indicated by the personal savings rate. So you can see here with COVID, personal savings rate jumped close to 35%, just a dramatic increase. Generally speaking, it's closer to about 7.5% or so. Now, we would suggest as financial planners that 7.5% is not enough in terms of savings rate, but 35% is also way too high. Even today, the personal savings rate is somewhere in the 13% or so, as of the last of what we have of the data. The end result is that what we have is what people are calling kind of this K economy. Keep in mind, we talked about the unemployment rate going up. So unemployment rate has been going up at the same time that the aggregate wages only went down about 0.5%. So you have a lot of people who were in lower paying jobs who are worse off today than they were prior to January 2020. But you also have a number of people who are in fact better off today financially than they were in a year ago. That's something that certainly we're aware of, and that the government, the new administration, is certainly aware of and thinking about as well.
Speaking of new administrations, that's the one thing we did know last year. There was going to be an election. So we got something right, but we certainly didn't know who was going to win the election. And I think the important thing to take away here is, and again, I think we've shown this slide before, but the big issue was that the election is over. And so often leading up to elections, markets tend to be a little weaker because of the uncertainty. And once things are finished and the election's over, that uncertainty goes away, and markets hate uncertainty, and that really helps things be able to move higher after the election. Also, we know that over long periods of time, whether it's a Democratic president or a Republican president, markets tend to go up. Now, that doesn't mean it doesn't matter a lot to us individually, how we feel about the president, how we feel about who's governing. Even who's governing the House and Senate really doesn't have a huge impact on the markets over time. In the short period of time that they are in office, we know they can enact policies that may have impacts, but those tend to be fairly shorter term in nature. We know that on the table is more stimulus and potentially down the road, higher taxes in some areas. We don't know what that looks like yet, but we would say that we wouldn't let who is president dictate our investment process.
It is now time for the 7th inning stretch. So what we'd like to do is, this is where client participation comes into play. What you want to do is you want to take your phone, move it up to what do they call those?
QR code.
QR code, and take a picture of it. That will get you to slido.com. And we are interested in is, what is your outlook for the stock market in 2021? And you just press the, oh, look at that. We've got one person is in. That's good. We got 2. Come on, we need to, oh, look at this.
Very cool.
It is. It's Very cool. We got 14. If we can get a couple more, that would be absolutely great. Gentlemen, what did you want to use this data for?
We want to get a sense for sentiment, right? How are people feeling? Are they feeling optimistic, things are going to be better, or are people more pessimistic and worried about where things are? So looks like we're getting some of that answer now.
Okay. There we go. Just a couple more. We'll take one more minute on the 7th inning stretch. We got to give these guys a little bit of a break. You did, I mean, absolutely wonderful. There were slides in there. This is like the 4th or 5th time that they've done this. And it's even the slides. And Keely, will want to thank you. Keely Mattis, want to thank you very much for helping put these slides together, which I think did a wonderful job of some entertainment plus communicating the thoughts that Seth and Marc had. Okay, 43. So it's 2/3 of the people have a more optimistic outlook. Gentlemen, take it away. Go back to you.
Great, thanks, Steve. Well, that's interesting. Let's jump in and switch gears a little bit and focus on valuation, stock market valuation first, and take a look at where valuation is relative to history. Now, this is a table that depicts many different valuation metrics. And really, no matter which metric you select, stocks appear to be relatively expensive, probably in the top 10% of history at least, across most of these metrics. And I think it's just important to keep this in mind. It doesn't mean that something's happening tomorrow. It doesn't mean that we're going to change what we're doing, but it does help to just keep things in perspective, that the risk is on the higher side relative to history than the lower side. If we look at this in terms of PE ratio, that's the price of the S&P 500 divided by the earnings per share of the S&P 500. In this case, going back to 2007, so through the last recession, and that's the red line is the PE ratio. The blue lines are different multiples of earnings. So a cheaper, if you will, multiple of earnings is 10 times toward the bottom, up to 24 times on top. So you can see back in 2008, 2009, when the market crashed, if you will, stocks got cheap. Stocks got cheap. That was a good time to buy. And through the last decade, really, we've seen, I guess I'd call it a secular increase in PE ratio. There are some structural reasons for that, but nonetheless, compared to recent history, stocks are on the high side at about 22 times forward earnings, on the high side from a valuation perspective. If we dig a little deeper, let's take it apart to its two pieces. So the blue line on top is the S&P 500 price level, and the red line is S&P 500 operating earnings. And you can see they move together through time, which makes sense. As earnings increase, you'd expect the stock price to increase as well. As earnings fall off, stocks tend to fall off. What we've seen in the past several years is actually a strong increase in earnings and some choppiness in the stock market. And then, of course, earnings fell off a cliff last year when things shut down and the stock market increased quite dramatically. So that difference there created part of the reason that we have the higher valuations that we have today. It's really maybe not fair on a timing basis. But for this year, analysts expect the S&P 500 to earn about $164 per share. That's the estimate up here. So this red line would actually come way up here toward the blue line and would compress, if you will, that valuation from a PE of 31 down to about 23. And the expectation is potentially that markets actually, that the S&P does better, maybe earns more than $170 a share. So here is the story of, look, if the market continues to grow, the GDP of our economy continues to grow at the rate it's growing, the expectation is that corporate earnings can grow into, if you will, the current valuation and reduce that PE ratio.
On the bond side, it's also not the greatest news in terms of, I'd say, valuation or yield. Currently, treasury rates, when we did this slide, is 1.15. Last couple of days ago, is 1.05%. And this is for 10-year treasuries. What this means is that if you buy a 10-year treasury today, your expected rate of return is about 1%. Corporate bonds are going to earn a little bit more because of additional risk. But this is a far cry from where we were 30 years ago, where you had yields of 8 to 9%. The bottom line is that the bond return expectations going forward for the next are less today than they were previously. The other interesting thing is to look at bond yields as compared to dividend yields. And today, dividend yields are greater than treasury yields. What does that mean? That means for income investors, dividends appear to be a little bit more attractive than treasury yields. Now, keep in mind that stocks do have a completely different risk makeup than bonds, but it does show just the relative attractiveness of the two investments from an income standpoint.
So let's talk about where we are today. Clearly, we have some tailwinds that bode well for markets and the economy. So we know that there's a vaccine being delivered as we speak. So good news, that's definitely a tailwind. We know corporate earnings are recovering. We've seen good earnings. In fact, if you strip out just the industries that were hurt the most from the S&P 500, earnings were actually up in the third quarter, and we expect they'll be up more even in the fourth quarter. We know there's pent-up consumer demand. Consumers haven't been able to spend. They haven't been able to take the trips, go to the sporting events, go out for dinner. So we know that that savings has been sitting in bank accounts, and that pent-up consumer demand we expect to come out as vaccines are distributed and we get back to a more normal situation. We know we know it may take time, right? So that there's additional fiscal stimulus on the table. We talked about that 1.9 trillion that's being talked about. We don't know what it'll look like at the end of the day, but clearly more stimulus likely on the way. The Fed has stood up and said, look, we're going to keep this quantitative easing going. We're going to keep rates low at least till 2023. So we expect rates to stay low. They may vary a bit around where they are, but we expect them to continue to stay low. Stocks look attractive relative to bonds, as Seth just pointed out, and the acceleration of current technology trends. We know that cloud computing, e-commerce, e-retail, some of the biotech areas, electric vehicles, we know there's a lot on the table in terms of technology that have been accelerating as part of this process as well.
But at the same time, I would say our eyes are wide open. So while we are optimistic, it is a cautious optimism. And so what could derail the tailwinds that we're experiencing? So certainly, really, COVID, increased spread, mutation, if that created a situation where there were further lockdowns, that would certainly throw the positive expectations for, say, a twist and a turn. Corporate earnings, Marc talked about corporate earnings growth, and if they don't come in or grow slower than expected, the market may not be so kind to those companies. Rate of technology adoption. We've made really just some technology leaps in the last 9 months. And so will that continue, or will people change how they're using technology? Stock valuations, as Marc showed from a valuation metric, are high. And so that's a concern. Big tech has been the driver of a lot of returns in 2020. There has been talk of potentially looking to regulate some of the larger tech companies with regards to concerns about monopolistic behavior. And so that could, again, cause some disruption in the market. Tax increases, that would probably be, if an impact, a one-time impact, but that could certainly, that one-time impact could affect markets. And finally, consumer behavior sentiment. We've seen some very frothy behavior by consumers. Generally speaking, that type of behavior tends to be when markets are on the high side. So that is always of a concern, something that we look at.
So we know the key. The key is the vaccine arrival, and that's really going to drive I think, how the economy recovers or responds in 2021. Going a little bit deeper into what's happening there, we know there's 2 vaccines that have been approved and are being distributed. Both the Moderna and Pfizer vaccines are on the markets around the world. But there are actually more vaccines, not just in quantity of the current ones, but there are actually more vaccines in phase 3 trials, 4 more, 13 in phase 2, 23 in phase 1, meaning that there's the potential to have much more vaccine available in the coming months than we expect today. And that could be a surprise if these things move faster than expected. I know Johnson & Johnson, I think, has something that's close to being approved. That may be 1 shot instead of 2. So to the extent that we can accelerate both vaccine delivery and efficiency, we could get the economy back on track sooner rather than later.
Yeah, and I would be careful about extrapolating current vaccine deliveries to what's going to happen in the future because of new drugs and improved supply chains as well.
We could move faster. Let's hope we do. So some of the takeaways, I think, on the investment side is we continue to favor the US over international markets, but we do like emerging markets. And we talked about that a little bit, mostly because of the makeup of those markets, with more higher growth and technology kind of names. We do expect more volatility in 2021. Now, a day ago, we saw the most volatile day, if you will, in several months, but we could see more volatility in 2021 as the economy recovers and as information about vaccine delivery comes to bear as well. We do think fundamentals can grow into stock prices as earnings recover. We did talk about that, especially in the second half of the year, as we get more vaccine delivery and we get more of the economy back on track. We expect positive, but possibly lower than trend returns in the next several years. So we've had a really tremendous increase this year, 18%. The past 10 years, past decade, I think stocks are up close to 15% on an annualized basis. And so, it's been fantastic. I wouldn't necessarily expect that really high rate of return over the next 10 years, but I do expect it to be positive. And we do expect that things will be positive this year, actually. We'd be cautious on the investment of the day. We know there's a lot of headlines, there's a lot of noise, if you will, out there. We use the acronym FOMO, fear of missing out. People are afraid, oh, I'm missing out, I'm not in the hottest thing that's on the market yet. That causes things to be volatile. People jump on the bandwagon, and we would avoid that if at all possible. I also want to focus for a second on what we can do and what we can't. So we know we can't control the markets, but we can do some things at Affiance to control our actions. So while we can't control the markets, you can rely on us for providing a disciplined approach to investment strategy. We have a disciplined investment process. We rebalance portfolios based on your target allocations. We rebalance based on our changes to portfolios during the year. And we react to market conditions. We rebalanced back in March when things were down, and we took some off the table for portfolios in July when things were up, and in October. So we are active in how we approach markets and tax planning. We did some tax planning last year when things were down. We did some tax loss harvesting. Not that we want losses, but when there are and there's an opportunity, we can take that to help our tax planning process. So again, we know we can't control the markets, but we can control our actions, and that's where we really focus.
So what can you do? The bottom line is talk to your advisor. We want to make sure that you review your investment time horizon with your advisor. Make sure your asset allocation is appropriate for your risk tolerance, your personal situation. Are you saving? Are you withdrawing? And make sure, review that with your advisor. We want you to be able to sleep at night because we do think that 2021 could have bouts of volatility as we've had in most years, and want to make sure that you're able to stick with the strategy. Try to block out short-term noise. There's a lot of it out there that may cause you to deviate from the strategy. I was looking at a website called Business Insider, and literally in December, they had one day where it said markets are going to skyrocket. 2 days later, it said markets are going to fall apart. Then 2 days later, it said markets are going to take off. I mean, it's not That is not a good strategy in investing to rely on what's being said in online or in the media. And understand the value of diversification rebalancing. We showed you in the slide with the difference between the smooth line of bonds and the down and up of the stock market, that there's a value to being diversified, because we don't always know what type of environment we're in. There's a lot of uncertainty in the market. And so having that diversification really helps to stay with the plan. And finally, make sure to have an emergency reserve for savers, and certainly for those withdrawing from their portfolio. We recommend a year of cash. We really want to make sure that you are able to be nimble and really try and mitigate that level of risk in the portfolio.
Steve.
There we go. I'm here. I'm here. Gentlemen. Okay, somebody had to applaud. We now have time for questions, and I've got a number of questions that have come in, but guess what the favorite subject has been? GameStop. Okay, so some of the questions said they kind of want to know what the impact might be. Recent trading, retail trading, current publicized short selling by groups. Another question was referred to this whole situation as shenanigans. And the last was small investors learning they can affect the market. Out of all the questions, gentlemen, will somebody explain a little bit of what this, and Marc, I'm going to ask you to do it if that's okay, because you're head of trading. What was going on and how might this impact our investors?
Okay, Steve, thanks for that. I guess let me take it from the top first. So this is certainly headline news, and we have a new situation sort of in investing broadly, and that's social media. And we haven't had that. It's been there in the past, but not quite in the same breadth that it is today. So whether it's Twitter, whether it's Instagram, whether it's whatever feed you're on, the ability to transfer information among millions of people quickly is unprecedented, right? And so in this particular case, a group got going and they knew that this particular stock had a very large short interest. And they decided, hey, we're going to try to do something here and upset the apple cart for the people that are short this stock and start buying it. When people are short a stock and the stock goes up, they lose money. And as that goes up, at a certain point, they have to actually reduce their leverage, if you will, and start to buy that stock back. They get what's called a margin call, which requires them to put in more money as they lose or buy the stock back. And so now the people that were short have to start buying it with the people that are buying it. And it's a vicious cycle that can actually have a result like we saw yesterday. This is a pretty extreme example of that. I don't necessarily think there's any legal issues around it, but certainly it's troubling that we can pull together people in a way today and do something that probably we wouldn't have been able to do, even several years ago in the same manner.
Marc,
yeah.
Who really got hurt here?
Well, it's a good question. The expectation is that the people that were short the stock, and the conjecture is that it was some hedge funds that were short the stock, that potentially got hurt as the stock rose dramatically and they started to lose money and had to cover their shorts at higher prices. So that's the potential. Now, of course, the retail investors that got in, it's really hard to day trade in general. So if you got in and got out maybe yesterday, that's great, but we know the stock was down 40, 50% today. And so actually the retail investors that played may have gotten burned now today with this tremendous volatility. This is the kind of thing that we would stay away from in general. And I think it's interesting because these kinds of things happen, but we don't usually hear about it. They don't usually make headlines. Maybe it's in penny stocks or things that are much more obscure, but it's rare that it makes the kind of headline news like we saw yesterday with GameStop and AMC.
Seth, is there any comment?
Yeah, I just want to talk about the legality of it for a second. Certainly, if it's a bunch of individuals, seems to be like 20 somethings in particular who are doing it just for fun in terms of kind of posting and kind of doing this, which is what it felt like, then certainly there's nothing illegal about that. On the other hand, if there was, for example, a hedge fund or fund manager who was holding the stock and then promoting it, and then in order for them to sell their shares, that would be illegal, and that the SEC is actively investigating to make sure that that's not happening.
They call that pump and dump. Pump up the stock and then dump it.
I'm going to move to a different question. Do you see any opportunities in those sectors that are at risk of disruption as a result of the virus? Or should we stay clear of those sectors? So you had a slide earlier. Don't worry, I'll stall.
Yeah, I think the jury's out. Let's put it that way. In other words, I do think that people are going to want. There is a lot of pent up demand. I do imagine that people are going to want to go on vacation. I think air travel is going to come back, kind of in general. Does that mean that a specific company is going to be able to make it or not? Much more difficult question. But I do think that you are going to see kind of that broad demand. Technology companies, the bottom line is that technology companies are able to increase revenue pretty easily without increasing their expenses. And that trend is going to continue. Again, there may be some hiccups in terms of regulation, but still that concept of being able to increase sales with little overhead cost, it is what it is. So those things in general, I think, are going to increase. Will it be like which specific ones? I think that gets a little bit more difficult, and certainly that's where we tend to work with either active managers or indices to try and capture that.
Thank you, Seth. Marc, can you give us your thoughts about government policies, fiscal or monetary, and their impact on what we're doing, which is helping our clients get to their goals through their investment portfolios? So, in other words, the influence that our government has on asset valuations.
Well, Steve, I think, a couple of things. So the first is, I think what they're doing is extremely important. We do know there's a huge hole from COVID and the government shutdowns and continued shutdowns in areas. So I do think what they're doing is extremely important in terms of keeping the wheels on the bus, if you will, during this period of time. Critical that they continue in the manner that they have. I think, over long periods of time, I also think it's important. I mean, we've seen the Fed step in continuously, in particular over time, to try to keep things even, if you will. And they have a mandate, right? Employment, interest rates, and inflation to some extent, to keep those things in line. And so I do think they play a major role in allowing the economy to continue to grow at a modest rate. And I think on the government policy, on the fiscal policy, I think there's a little bit maybe has been less impact in the past, maybe a little more impact in the future. And I think that they will also focus on ways to continue to keep our economy growing at a nice rate. How does that impact us? I think it impacts us in that it allows us to know that as we look into the future, our expectation is that we will have the foundation, if you will, for continued economic growth through time. It doesn't mean it'll be perfect, but I think the intention is that we'll be able to continue to grow our economy through time.
Okay. This is our last question of the evening, because we want to be respectful of your time, clients. Seth, the new administration is talking about taxing unrealized gains, something like a wealth tax or something of that sort. Do you have thoughts on this? And have you heard of this as well? And what might be its impact on the investment world?
So I would say, thank you for the question. I would say my general motto is, when it comes to taxes, is don't trust the government. In other words, the number one thing that can really impact your net worth is taxes. And throughout my career, being as a CPA as well, taxes do change and different government policies will come and go. And so on this specific policy, I think the jury is out. Do I think that taxes are going to go up in the future? My personal belief is yes, taxes will go up in the future. That was part of the new administration's platform. And so for now, I'll take them at their word. And I do think that that is part of what we can help you with. We at Affiance Financial is really thinking about ways that we can help improve your tax situation. And that's really an important conversation to have. On the specific policy, I don't know if there will be a wealth tax per se, but I certainly think that realized capital gain tax is certainly on the table. In other words, increasing the realized capital gains tax. So something to certainly for investors today to be thinking about.
Thank you, Seth.